Welcome to another edition of Stock and Tonic. Right now, we're going to be looking at the disastrous earnings report from Nike, a stock that the last 6 years looks like a big giant hump. Up and down, up and down. I mean, at its peak in November 2021, 177 stock market price. Now it's at 45. It dropped 14% today. I think maybe closer to 15%. It's not doing good. Why is it dropping? Well, that is a couple of key metrics we will be going over because they had a pretty good report. They beat earnings, but they projected weak overall guidance. And we're going to break down that guidance because, again, their earnings were good. They weren't great, but they were good. You thought they would stay flat or even pop a little bit, 3, 4, 5%, but they did not. And the reasons are quite simply, these three things for their weak guidance. One, China remains a major concern. Nike warned that the Greater China could drop around 20% in the current quarter. Sales have become a huge drag for Nike in China. They acknowledge that. Management for Nike has acknowledged that the region remains weak, and it's a long-term growth story, whatever that means. It means that they're trying to figure it out. Two, they margin pressures from tariffs and promotions, right? So in the past, management had a lot of promotions, had Nike doing. They are not doing that anymore, so they're losing on those sales. And of course, the tariffs from the Trump administrations are just eating up all the profit. Net income fell about 35% year over year. Gross margins declined, driven by, again, higher tariffs in North America and inventory cleaning promotions. And sales guidance missed expectations. That's pretty, and that has a main for China. The sales guys in China missed their expectations. Now we're going to focus on the big reason why the stock is plummeting is because of China. Now let's take a look at some of the key metrics, financial metrics for Nike. Again, everything looks not horrible. I mean, it's not great, but the negative stock review down 15%, or down 14%, not 50%. It was 15% a second ago. Their dividend is 3.62. Nice. The P ratio is okay. Lots of volume today, but yeah, you can see just net income, net profit margin, just being eaten up, mainly from tariffs, any promotions, and then the big one is China. And so one of the things that investing.com article was written, and what they think Nike needs to do, and I do agree with them. Let's look at that. Actually, I think it's this one right here. Yeah, 3 things Nike investors need to watch when stocks plunging after earnings. And so the real thing we want to think about is: do we buy now? Do we not buy? Or if we are going to buy, do we buy now? Do we wait until it really hits rock bottom because there's more pain to go? Or do we don't buy at all because it's just kind of a garbage stock, and it's going to become a garbage stock, right? Just a typical shoemaker or shoe designer. They don't make their shoes. So you can see what 3 things. It's down farther, just going over the China. They need to pivot, right? So management needs to pivot back to the sports offensive. I heard this before where they need to focus less on luxury design is more as it's more of a sports product, right? Really leaning to the sports. The state of the Nike shopper, especially in China, especially in the Middle East, that's a big one too, where war going on. It is considered a luxury item in China and in the Middle East, and even America too, because it is a very, very expensive shoe. Europe is a big one too, where it did not have a great quarter in Europe. That's something that's being, you watch CNBC or investing.com or anything like that. They're really pushing China. And China is the big one, but Europe is the second market. And if sales sell 7%, again, that's probably due to, ending promotions. That's probably a big one. Ending promotions. The war is a big one. Tariffs are a big one. So it's nothing really. Nike has, some of it's not Nike's fault, right? Some of it's the tariffs they have to manage. It's a lot of different things. So Same here, 14% sell off. Better than expected, but it's the news that the greater China weakness remains a critical vulnerability to Nike's turnaround. I think this is kind of a classic, and we'll watch a video on CNBC. This is a kind of a classic. This is a turnaround that's taking a lot longer, kind of like Starbucks too. Same thing. I think Starbucks is farther ahead, but Nike is kind of, they're facing a lot of challenges out of their hands, right? There's a war going on. There's high tariffs that's kind of out of their hands. If those two things weren't happening, I think the stock would be in a better place. And also, I think this number right here was artificially high because of, this is the peak COVID. This was peak, investing in shoes as an asset, which is not true, kind of ridiculous. It probably should have been closer in the 120s, I would say, not the 170s. Still way off its mark, and it needs a long ways to go, because strategically what they did was they got out of Foot Locker. They got rid of all the retail spots, retail stores, and they want to do direct to consumer, which, well, we all know that didn't happen. That didn't work out very well. So I want to play a video kind of reiterating what I talked about. This is from an analyst from Jefferies, kind of like, what Nike needs to do is potentially to grow its business. So let's click on that.
Nike shares getting hit hard today. Here's what we learned. So we got more visibility, but also learned it'll take more time to turn this ship. There are signs that it's still working from the numbers, notably North America and momentum in the wholesale business. New products in running and football have been hot sellers. Management also hinting that direct to consumer, which is their stores and their website, which has been under pressure, can return to growth quickly. It did grow, according to executives, in February in North America. But China is still a big problem. And EMEA, the other big region, it's going to follow the North American playbook and is just not there yet. The CEO, Elliott Hill, has been making a lot of changes in leadership, including in recent months. New leaders in China, in EMEA, and at Converse. I spoke to Nike about all this last night, and here's the story. In part, because they have that new leadership, there is new visibility now on the depth of the challenges and just how long it will take, which is why they introduced last night longer-term guidance for the first time in a while. The problem is it didn't include growth. And for investors to see long-term guidance, they wanted to see growth. Now, Nike expects revenue to decline by low single digits in 2026. Nike's bigger and more complicated than the competition, the On-Runnings, the Hokas. The geographies are more complex, the categories are more, and so they're arguing it's harder to fix all these problems quickly. But investors are short on patience, we know, which is why they and more analysts today are pushing out forecasts of recovery to take longer. Let's bring in one of those analysts, Jefferies analyst Randy Koenig. He has a buy rating on Nike, $90 price target on the stock. Randy, you like the story.
Yep.
But do you agree it's just going to take longer now?
Look, I think you should be an equity research analyst. You encapsulated the summary pretty well of what's going on. But look, I think first and foremost, we can't forget the way that Elliott is attacking the problem, which is one geography at a time to fix, one product category at a time. And for the last 3 quarters, they've shown that progress. Running is up double digits, 20% in the last 3 quarters. That is a big positive. The North American business growing. And as you pointed out, wholesale also growing as well. So I think that's the first step of the puzzle. And remember, this is the most ubiquitous brand in the entire world. It's going to take time to fix. And Elliott's the right person to fix it. And he's making the right decisions to fix it. It will take time, but he is making the right strategies.
So what does the timeline now look to you? Now that they do have more visibility, they are giving more guidance. What are we looking at in terms of recovery times?
Look, I think we and the rest of the market had to take a more sober view of what we saw here. And we saw a business that we initially thought would turn in fiscal 27. Looks like it's going to turn in fiscal 28, which ends in May 2028, given the fiscal year. That is the reality of the situation here. And why? The reason why is the company needs to reset product in China. They've already started to see some green shoots there. It takes time. And then Europe took a step back, right? The European market is more promotional. That's a reality. It doesn't help with the Middle East war. It's going to take time to fix there as well. But I think, again, what I'm taking away from this is Nike did a good job of re-solidifying what Nike's great at, which is product and balanced distribution and being the #1 brand. And that's not going to change. And now you can buy that #1 brand at its lowest valuation level on a price to sales basis or market cap basis in 15, 12 years. It's very low, very attractive.
I know you think.
The analyst from Jeffrey was saying, listen, it's Nike. It's not going anywhere. They have very, very, very smart people in charge handling this. This is something that's going to take much longer and more time. They got a lot of things coming their way. Again, tariffs that are out of their hands, a war that's out of their hands. China's a very, very complex country that they have to manage. That's kind of out of their hands. I mean, somewhat, right? They have weak customer demand in China. They have more competition in China than they did 10 years ago. Product misalignment and slower innovation growth in China. And again, pull back from their promotions. And again, geopolitical risks, right? They know this and they're going to be fixing it, right? So I do agree that's probably, I don't know if it's going to be $90 target price, but I think it's going to have to go up. The real question is it going to be bumpier, right? Is it going to go down to, let's say, 40 or 35? I really don't know. It looks like North America is stabilizing, but China really remains unsolved, and that's going to be very, very tricky. So we'll see. I think my gut says it's going to go down a little bit, probably to like 40, and then straight up, right? Forget about this. When you see this scary chart, this bump, this would not have been this high, right? It was COVID drunkenness, which was basically everything was overpriced at this time period. So it really was around 120, 110, I would say. But still not great. But yeah, I would probably put this as, let's just hold off. Let's not buy this. Let's just watch this, because I do think it's going down a little bit more. If it goes under 40, I think it's a buy. But because it's a good company, it's a good stock, good management. And yeah, I think that's it. So that's all I have to say. If you like what I said, hit the like button and subscribe if you really like it. If you think this stinks, please tell me. This is only my 3rd or 4th video, and I'm trying to get better. Thank you so much, and have a good day.